All right, guys, this is episode 38. We have a special guest on today. It is Jacob Campanaro.
Right on.
That's
Yeah.
pretty close.
Nailed
There you
it.
go.
Yeah.
I would say it in my Italian accent, but I don't want to embarrass myself.
You're Italian in you.
What?
You're Italian?
Yeah, my dad was born in Italy.
Oh.
I'm a first generation Canadian. Even though I get
My
hate for
grandparents
saying,
were born in Canada. That makes me so Canadian.
yeah, you're very Canadian.
I'm very Canadian.
Yeah, we're getting sidetracked here.
Okay.
Anyways, he's a sales rep, but he does commercial, so it's a little bit different than what Brooke and I was talking about, which is res. We're going to get into a few things like investing, private lending, and everything like that. Jacob, thanks for coming on the show.
Thanks for having me, guys.
100%.
Why don't we get started with the commercial market and how that's performing right now? Because I know that when we talk about the residential market, the commercial market can be very different at times.
Yeah. Well, it's different driving factors, right?
Yeah.
Between the two markets. Something we educate our clients on is the fact that the commercial market is mostly driven on income, right? It's almost like a business. You're buying an apartment building, let's say.
Mhm.
It's like a business. It's going to cover itself. It's going to cover expenses. It's going to give you a bit of cash flow. And that's what everything is driven from, is that cash flow, right? And with interest rates going up and where we are today, it has different effects on the commercial world. So just to dive into it, where are we today? Well, as I'm sure your listeners know, interest rates are up. We are seeing the bond rate come down, which is interesting. So with commercial, the rates are driven by bonds,
Okay.
right? So it runs a little bit differently.
Is it because most of them take fixed rates?
Yeah.
And but you can have a variable rate on a commercial mortgage.
You can. Right now, most deals are getting done with CMHC financing, which is driven right off the bond rate. Now, it is a fixed rate.
Yeah.
So basically, it floats up until the day you close, more or less. And then it locks in at that point.
Oh,
Interesting.
So you can, for a fee, there are some lenders that will fix your rate, right? So you can say, okay, a couple months before, let's lock it in. But right now in the market where things are trending, like honestly, a month ago, a CMHC, which is we'll go into that if you want.
Yeah, definitely go into that.
A CMHC commercial mortgage, your interest rate was 4.75, 5%. It's now today all the way down to, we're just doing a deal right now. We just got locked in at 3.8%.
Wow. So just
down
to
quite a bit.
Yeah, comment on that, because people would be like, well, how are they getting that rate when the overnight rate is 5%? Well, the bond yield is attached to the fixed rates. I had this conversation yesterday. So wherever the bond yield is trading at, typically the fixed rate would be a little bit above that. And then since it's CMHC, that means it's an insured mortgage.
Correct.
Which means they can offer a little bit lower of a rate because the mortgage is backed by insurance.
Quite a bit lower of a rate, right?
Yeah.
So
like even when you have, even on the residential side, just for our listeners, if you have an insured rate, you're putting less than 20% down, but your rate is actually going to be lower than if you had 20%, which people can't wrap their heads around sometimes. Even when I first heard that, I was like, what the hell, what are you talking about? Like, you're putting more money down.
However,
you're a better candidate.
I don't agree with that. We are getting a little sidetracked here, but I just want to comment. So if you are buying a house for $700,000 and you're thinking, okay, well, I have a rate at 0.5% less if I don't put 140 down, which would be 20%, or I have to pay a higher rate but put 20% down.
Yeah.
Because your mortgage is going to be a higher amount but a lesser rate, you're mortgaging a higher amount, so it's going to kind of
risk.
equal out.
Yeah. You're paying insurance on it, so you're paying a premium that doesn't go to your principal.
Yeah.
Yeah.
I would always put down 20% if you can on residential. Now,
For sure.
Jacob might say completely different than what I say
it's
right now, because I've heard him talk about it.
Yeah. Well, so just going back to, let's focus on apartment buildings right now.
Yeah.
That's the topic of the day, or the topic of this conversation. So again, because the market is a little uncertain, and I'm sure anybody that's looking in commercial investing right now, they're scratching their heads. Nothing's cash flowing. Nothing's making sense. You almost have to go with that CMHC mortgage. And so what I'm talking about when I say CMHC mortgage is, it's an insured mortgage, but it's through the commercial channel. So it's done a little bit differently. A CMHC commercial mortgage, what the benefits are is the rate is lower, as you mentioned, but you're also going to get a longer amortization.
Like what?
On your mortgage. Well, it can go up to, depending on the program you're using, you can get amortizations all the way up to 50 years with commercial.
Ooh.
Now that's the max,
Yeah.
right? But what we're seeing right now is anywhere between 35 and 45 years. So it's quite a bit longer than a res mortgage.
Right.
And if you can imagine, that's helping dramatically on your monthly payments.
Oh, huge.
Right.
You're
On
almost
top of
doubling
that,
it.
it's going to reduce your down payment as well.
Right.
So with commercial, it's that fine balance between where do I cash flow? Where's my cash on cash return? And how little can I put down?
How little
That's
can you
always the
put
battle
down?
we have, right? And
Hilarious.
trying to fine tune each building into that perfect
Right.
solution. So a lot of investors, I'm going to speak to my clients because everybody's got their own thing, but you're looking for something like a 5-6% cash on cash return on the purchase, which means
Okay. So that's the cap rate.
no cash on cash. So it's how much money am I putting in and
Oh,
how
I
much
see.
money am I
Okay, yep.
getting out? It's
Yeah,
the
yeah, yeah.
return on your
Got it.
actual
Yep.
Yeah.
cash. And so we're looking for about 5-6% on a purchase. I'm sure there's somebody yelling at their TV screen or their computer screen right now going, I need 10. And I get it, right? Everybody's different. But I'm saying for a typical Burlington, Oakville, Mississauga purchase, we're looking usually for around 5 to 6% cash on cash return. And we want to maximize that loan to value. So a little bit different than the 20% down.
Yeah. And it's so interesting because when I help clients buy residential, we're thinking about future value too, whereas commercial's so different where it doesn't just appreciate like a residential does unless you overturn it, right? So I hear you because Jacob actually, we work out of the same office.
Yeah.
So I hear him on the phone, he's on the phone. So I learned just listening to his conversations. So you overturn the rents in the building and that's how you revalue the building. That's how you force appreciation.
Yeah, so everything's going to be driven off of income, like I mentioned previous. So there is passive appreciation, but it's not the same as residential, right? Residential markets, and you correct me, but I find it's driven off of obviously supply and demand. Like that's the way I kind of look at it. Being a commercial guy, I'm always like supply and demand. With commercial, yes, there is supply and demand, but you can only pay so much for something that's not making the money. Right.
True.
You can have somebody, sure, they can come out and buy cash and they'll
Right.
they'll have cash flow like crazy, but nobody's doing that.
Right.
Right.
Commercial is driven off investment. It's not driven off
Correct.
let me live here and raise my
There's no
family.
emotions.
Yeah,
Yeah.
Let me put the white
Is that
white
why
kitchen.
you transitioned from residential to commercial?
Yeah. Well, so I've been in real estate for 7 years now.
Yeah, yeah.
Almost. So the first year of real estate, I was in residential.
Yeah.
And yeah, it was a big issue for me. I'm a numbers guy. Like I love numbers. And my big thing was always appraising residential real estate. To this day, I still can't wrap my head around it sometimes. Because I go in there, I'm like, okay, you got 3 sales in the neighborhood, this, and this. And then you go sit down with the seller and they go, but I got interlock.
Yeah.
Okay. Right? But I got an in-ground pool. Okay.
It's actually
How
a hard.
much is interlock worth? Do you guys know? I don't.
No, it's a hard conversation to have because people will be like, "Well, I put $100,000 in the backyard." So, well, that the return doesn't mean that. Like, just because you put $100,000 doesn't mean it's going to add $100,000.
It's
to your
not
purchase
dollar per
price.
dollar.
No,
right?
it's not dollar. It's all subjective. It's what will a buyer be
And
willing
it's
to pay.
all dependent on the market because if you had have renovated right before the COVID peak and put that money in, you probably would have saw more that like if you put 50 grand in your house, you probably would have seen 150
Yeah,
return. Right now, you put 50K in your house,
don't
you
do
come
it.
get 50K.
Yeah.
Don't do it.
Yeah, don't do it. Yeah, like should I get the whole house
No.
redone? No, like go paint it on the weekend yourself if you can make it happen. That's probably the best way you're
Yeah.
going to see a return.
yeah,
Change some
yeah.
light fixtures,
Yeah.
like very small things.
Yeah.
But yeah, like someone's like, should I renovate a bathroom? I'm like, I can't guarantee I'm going to get that return back for you. So no, I wouldn't. Yeah.
That's
I
that was
wanted
challenging.
to ask you the question because there are people that reach out to us and say they want to invest because a lot of what we talk about is investments. But I, like cap at the triplexes. I don't even do a lot of triplexes. It's mainly the duplexes,
Mhm.
and then anything above 5 becomes a commercial mortgage. So
Yep.
this would be if you guys came through us, we would likely connect you with Jacob.
And that depends on the bank. I do want to say that.
Yeah. Okay.
So there are certain banks that will allow 5 units as residential. 6 is usually that number where like 6 is the hard.
Yeah. The hard.
Yeah.
Now it's
And even
commercial.
then there's some banks that might squeak it by as a 6 as residential. It's rare, but 5 is kind of 50-50.
Huh.
So I just wanted to mention that because I know, again, I'm sure
Okay.
there's somebody in the comments right now going,
Yeah. Everyone loves to correct
I
us.
know.
I know it's hilarious.
So if you had a client that was looking at a 5plex, so this would be like a very small rise building, and then they had the option to take commercial financing or residential financing, 100% commercial financing sounds like it would be much better.
That's the way I would lean. Yeah. And that's why the fiveplex is kind of a weird market. Because you could have, I remember, and I don't do much fiveplexes because I actually recommend people go to the commercial, like go to 6, go to 8.
Yeah.
If you're going to do 5, let's do 8.
Right.
Right. And we'll figure out a way to make those extra units, we'll work it through, simply because the economy of scale. Right now you got 8 units paying rent, 1 roof, 1 boiler.
Right.
If one tenant leaves, you'll be okay.
Yeah.
We've built that into our numbers.
I hear you.
And that's why I love commercial and multi-doors.
Yeah.
Whereas a duplex, one tenant leaves, that's 50% of your income.
Totally.
Right now, we're lucky that being in Southwestern Ontario, GTA, leasing's quite
Easy.
popular, right? It doesn't sit vacant for months and months. Now, if we think of retail or office or any of those asset classes, which I'm sure we'll get into, it's a little bit different. Right now, we're talking potentially 6 months of vacancy, a year of vacancy, depending on the market and the asset class that we're talking about.
Yeah, because commercial has so many, even when I'm looking just for something so basic of like this lady wanted to do like a hair salon space. And I'm like, I don't even know how to look because there's warehouse, there's retail, there's a lot to know into commercial.
It's fun.
Let's pivot though. Let's pivot to office and retail.
Okay.
So I know you don't specialize there, but I think it'd be good to talk about because I'm seeing guys. I watch this podcast called the All In Podcast. They're the billionaires of like Silicon Valley, but they just talk openly about the commercial real estate market there and how people would buy stuff 10 years ago.
Yep.
And today it's worth like 50% of what they bought it 10 years ago. And like they can't even get people in the space because people are building teams right now, and tech always has good margins. So they're building teams across the country or in other countries because and they're saying we're never going to get everyone together. It just doesn't make sense because of economies of scale.
California's actually got a really big issue with that.
Yeah.
Specifically LA, Silicon Valley, that area.
Right, because with the new, like the tech world now, you don't need to be in the same office. You can essentially remote work from anywhere. And since COVID, I'm sure
there's a whole bunch of different reasons. Like I even recently read an article about Walmart's closing down because of theft, like internal theft. Yeah, like there's just
internal.
Here too. But anyway, California does have a big issue with office and retail. Moving that to Canada and to Toronto, we're not that much different right now. It's a very
even the overhead, right? Like why? Like if you can cut your overhead by 10% by getting rid of this, I just made that number up, but by getting rid of an office building, right? And then everyone's working from home, they're paying their own internet bill, whatever it might be. Like, why would you not do it? And I understand like the culture and you need culture, but I think that depends on certain businesses. Like someone doing an Excel spreadsheet doesn't need culture. Am I wrong in saying that? It's like, you don't really need, like,
you don't need culture.
Yeah. Like, am I going to spend $40 million in a building for, John to run an Excel spreadsheet, or can he just do that from the comfort of his own home?
So what we saw was, and this all started in COVID time, let's call that a thing, right? So that's a whole nother podcast, but so everybody went to the work from home model. We were expecting this. We were watching the trends over the last 3-4 years where everyone went to work from home, right? And all these office leases started to come up. No one was renewing. Nobody needed to renew. They were all working from home. They saw that there was overhead benefits, right? It wasn't as expensive to have people there. What's interesting though, is we are seeing a resurgence of office. We're finding a lot of companies are coming back into office space and doing a hot desk model, which essentially is anybody can come work at the desk. Right.
Yeah.
Or anybody can use that office. So it's a shared office space within the corporation or within the company.
Makes sense. A smaller square footage.
Exactly. Right. So what we're seeing right now is the 10,000 square foot office holders have now left 10,000 square feet and they're going to 2,500.
Wow.
Or 3,000 square feet. And so there's a big demand right now in city centers as well as outside the city, which I'll talk about in a minute, but for smaller space. And I'm sure you'll see a lot of co-working things pop up all over the place. I keep seeing them. Every corner has like a co-working office now because of the demand. What we've also seen, which is really interesting, is a big demand in secondary and tertiary market office.
Okay.
So for the GTA people, Burlington, Oakville, big office market right now.
Huh.
Like I have a number of clients there and we're leasing no issue.
Interesting.
Who are you leasing to?
Well, so that's exactly it. It's the same companies that were in Toronto downtown, but now they're saying all of my employees are coming from Hamilton, Burlington, Oakville,
Everyone's commuting.
Mississauga.
Let's just go.
So why don't we find somewhere that's going to be half the price, B, there's more parking, it's more convenient, and my employees are going to be happier
because they don't have to drive.
They don't have to drive into,
the
downtown core. Even though if they're coming from North Mississauga to South Oakville, maybe it's the same kilometer difference or the kilometer drive, but it's half the time in the commute, right? No traffic, nothing like that. So we're seeing a big demand for that, and a big emphasis on employee drive times and employee satisfaction, because they're trying to get their guys back to office because they're missing the culture.
That's what
it comes to.
My quick stint in the corporate world was a 4-month internship, and the worst part about it, and I did Excel spreadsheets. The worst part about
That's
it,
how you
culture.
know.
I am Johnny. I was the Johnny example.
Yeah.
But the worst part about it was the drive, like driving for an hour to sit at a computer and then drive back. Because basically, what I did was being the nerd I am, I would run Excel spreadsheets on cafeterias, and I would see basically what food would hit and what would lose. And it was for high schools and universities.
Mm-hmm.
That's cool. I didn't know you did that.
Yeah, so I'd run all these different.
No wonder you're so like into the pro formas and all that. You love that stuff.
Yeah, it's pretty fun.
in
So
your
where were you
blood.
when my cafeteria went to like healthy food? Went from pizza to like
Remember
vegetables.
that?
Vegetables, yeah. So the kids don't want vegetables. I can tell you.
I can imagine.
But anyways, the worst part about it and why I hated it so much was that I would work 8 hours, but really I was working 10 because I'd have to drive every day. Like if I had an extra 2 hours of my day, I would have been way happier. But then I just said, I can't do this. Like I hate this.
I would not last a second.
Yeah, so
how long would I last?
you?
Yeah.
Oh, 3 days?
If that?
Yeah. Just you sitting in an office.
Well, and that's exactly it. It's hard to build culture when your employees are already coming in pissed off.
Oh, yeah.
First thing in the morning.
Yeah.
You just sat in traffic for
Yeah.
an hour.
Right.
Right?
Yeah.
Like talk about a morale killer for the office.
Yeah.
Right. And so that's where we're seeing the markets really come back in. Now, something we're messing around with right now is office to residential conversions.
That's what I was going to ask you
So,
because
That's a big space that you don't hear much about right now. I think it's going to become bigger and
I
bigger.
think so too. Think about all the buildings that are in Toronto that if they're leaving those behind and getting a smaller space, like the towers and towers of just offices.
Yeah. And it's already, most of the Toronto office buildings have res above.
Right. Would there have to
maybe
be a
not the
mass?
core A-class downtown.
Yeah.
Like, look, the TD building, the BMO building,
yeah.
they're always going to be full. That's a A-class downtown building.
Right.
Yeah.
But look
The
at the
financial
stuff
district.
in the districts around that.
Right. The ones that have the residential units above them.
Yeah.
Is that a major thing to go through in terms of the zoning in the
That's
city?
the catch, right?
Okay.
Yeah, is
The expense of it.
That's
too.
always the catch.
Yeah.
We
it's
talk
the
about
it's
that
the
all
biggest
time.
catch right now.
Always
So the
the
city
catch.
needs to, and I do believe they're going to go that way, is start easing up on the converting of zonings for.
They're going to need
They
to.
have to, right? There's so much. So I met with a guy a couple weeks ago now who's doing it in Windsor. He's actually converting office space in Windsor, and he's making like money hand over fist right now.
No way.
Does he say it's hard? Like the plumbing, I'm just in my head, I'm just thinking like, say you have a 2-bedroom condo, you're going to need plumbing for.
That's the biggest thing.
Yeah.
Right?
Like
the cost is also,
is the margins make sense? Like you already have the frame, but now I need to redo all the internal parts of it.
that's the big challenge with Toronto, is that the cost to actually buy the building and convert doesn't make sense right now.
Right.
So one of two things have to happen. Either the timeline has to become shorter, which means zoning and all of that has to become quicker. Prices have to come down for office, which
Yeah.
in certain areas we are going to see that slowly decline.
When you
Right?
price out an office, let's say in Toronto, because I know that when we're pricing out buildings, let's say in Hamilton, it's based on what the rents, like the income approach of what the building is making. So if you were to sell an office space in Toronto, is that less based on it? Obviously, there's no income because it's an office space. Is that more based on the actual structure, location, just kind of like residential?
Yeah. Well, you're going to look at a couple different things per square foot.
Oh yeah.
Is kind of the go-to, right?
That
So
always
if you're
messes
selling,
me up on the system.
industrial or vacant office, you're going to look at a per square foot sale price. And
Based
that's
on comparables, like you
based
do,
on,
like
it's just direct comparison approach,
Okay,
right?
okay.
So you leave the income out of it. Now with office, because every day they're like the prices are coming down for office, so
right.
you have to watch that and see what happens. But I do think in markets surrounding GTA, Mississauga, Burlington, Hamilton, Oshawa, Scarborough, go out that way too, there is going to be immense opportunity for office conversion.
Interesting. Hear that, guys.
As the vacancy increases. We got huge vacancy rate right now.
And would you get so it's a commercial space, so a commercial mortgage, but it'd be different, right? Because there's no income, so the bank's not looking at that.
Yeah, so we'd structure it as almost like a construction mortgage, right? Construction mortgage, right? So you're coming in, you're going to talk to the bank and say, this is what we're doing. We're buying it for X. Here's our build out plan. We're going to take this 10,000 square foot office building and convert it into 20 units, right?
And then what do they use to verify that?
They'll look at the end value and say, okay, on complete, you'll get an appraisal, and the appraisal will basically be, okay, what's the value today?
Right.
What's the value on complete?
And then you'll refinance it on complete.
Correct.
And then it'll be...
If you put your numbers right, you should be able to refinance it as a residential apartment building.
Right.
And use CMHC financing.
And pull your money out.
And get like 95% loan to value.
And then now it's a residential. Now you have no money in it.
Now you have no money in
it. So sick.
Right?
Okay, so when you're first going to buy the place, though, to get that construction, like I'm sure that's tons and tons of money to convert. How do they verify? Like I get that they see the end value and they say, okay, there's opportunity for me as Mr. Banker to make money here, but Joe Schblow couldn't just go and be like, hey, I want to do this. So what's the process of being a qualified person to get one of those loans?
So track record, net worth, management experience are kind of the...
So interesting. So it's kind of like an interview.
More or less, right? So if you go through CMHC for this process, they are going to ask for net worth. So what is the net worth of the person? So the rule of thumb for CMHC mortgages with net worth, you need 20% of the loan amount, you need to have a net worth.
Okay, so let's say I wanted to do something like that. Okay, so I have 3 properties. So they would look at the current mortgage on my properties and what it's worth.
Yep.
They wouldn't obviously they would minus the mortgage amount because that's debt.
Correct.
So they would add up all the house's equity portions of what I own. And if that was 20% of what I need,
the loan amount,
then that's okay. But then I don't have any previous experience. What would I do if I was new to this?
So you would go out and you'd find a contractor that does have the experience.
Right? So partner.
And so it doesn't even need to be a partner. You can hire them.
Yeah.
Right. But CMHC is going to look at them and say, okay, yeah, this is a qualified contractor.
In terms of doing the actual work, experience converting. Okay. Correct. So now I have Mr. Contractor and I have 20% of the loan amount.
Yep.
Now
they're going to say, okay, what is Brooke's experience with managing a 20 unit multifam building on complete?
So what if I have our property manager that we use? Hey, I actually have a property manager I use for the rest of my residential, which are only duplexes. Yep. He's going to be the one managing and he has experience. Chris,
perfect.
Per se.
Done. Right. So that's how we're doing it with clients, right? So we can have clients with I wouldn't say no experience. This is there's a lot of risk in doing this venture.
Right.
There's the zoning process, the time, the carry cost. So I'd say this is something, let's call it for a more intermediate investor who owns a few buildings, has the experience, has done some renos. But we can build the right team for that person to go in and do these things. Right.
That's so smart for our listeners because people are like, I want to do this, but have no idea how to get started.
Yeah. So it's the bank's smart, right? Like the bank is going to do their due diligence. They're not going to lend on something that doesn't make sense. So you have to prove to them.
Smart because if the bank is lending you, so I have 20% of the loan amount in my houses. I don't even have to pull it. Here you go. I'm showing you that I own stuff. Now give me a loan to do what I want to do. Now you're funding the project. And then at the end, your money is now making me money. And I didn't do anything.
Yeah. Now there's going to be a down payment for purchasing.
And
there's going to be capital. There is capital cost, right? So I don't want it to make it sound like it's
I'm not saying it's all sunshine. Like obviously that you're going to have skin in the game. Of course you need a down payment, but it does seem like almost fun when you're like doing it that way. It's like
so it's
creative.
And again, anybody who works with me will know like the first thing I talk about is the team. The team is so important.
Yeah.
Whether that's your accountant, your mortgage broker, and your realtor. Or it's the contractor, the commercial broker, the capital partner, right? Find the team, and then we're going to
You have the team based on what a client's desire would be, and you would help build that.
Yeah, so that's what we've done from day one, and what's made my business successful, right? Is is we started with our graduating to commercial program. So I did this for the first like 3-4 years of when I got into commercial, and it was taking duplex, triplex buyers, bringing them to 6, 7, 8, 9, 10, right? And we've just added to that. So we still run that program. We still work with a lot of first-time multifam buyers or mixed-use buyers. But the guys that now own 5, 6, 7 buildings, they're coming to me and saying, "Okay, Jake, what's the next thing? Like, how do we?
I need more.
Right? I need more. Right? I want more."
I want
and
6plex.
yeah,
I'll be
Talk to Jacob.
Yeah.
He's a stone
so I'll
throw.
get you the team.
Yeah.
that's
So,
funny.
and this goes for the same thing. Like moving away from office for a second, even if you were to buy a vacant multifamily building or a semi-vacant multifamily building,
That's actually
this
better
program-
than if it was tenanted, no?
the
Like low rent tenanted.
yeah, low rent tenanted. Now we got to watch out for, we live in Ontario. We have rent control. We can't evict tenants easily, right?
Yeah.
So there's that whole conversation here. And that's something we do have with our clients as well, right? We never recommend going in and booting a building out, doing cash for keys. Like that's not something that we're going to suggest you do. I don't think it's a viable strategy for investment.
Mm-hmm.
Right.
Agree.
Number one, because, well, that's where people live, right?
Right. Especially if they're paying $500 a month. Like,
yeah. So it's tough
Hamilton.
because like $500 a month, that directly affects the value of your building, right? So think of it this way. If we're buying in a market at a 4% cap rate and you can get that tenant from 500 to 700, take the $200 and apply it to a 4% cap rate.
and market rent's $1,700.
Exactly. Right. But just like every $25,000 you earn, or $25 on your building, excuse me, like it's exponential when you're applying it to a 4% cap rate or a 5% cap rate.
And then eventually, if you're able to eventually get them out and then market rent becomes $1,700, think about the difference in value.
Yeah.
6 units paying $500 compared to 6 units, people paying $2,000, that building's going to go from, it's going to increase literally millions.
And it can happen overnight. That's the
That's
really
so
cool part about
Yeah,
commercial,
that's
right?
cool,
So you don't have to wait for the market to catch up. You can
Mhm.
literally go in there and be like, okay,
Sick.
we got a vacant building or we got a semi-vacant building. Let's reno 50% of the units that are already vacant
Mm-hmm.
for this example.
Yeah.
We're going to increase rents from 1,000 to 2,000. Now we have,
And then you refinance it and take a payday.
there you go. Right. So it's,
Love it.
Cool.
Music
It's-
mirrors.
yeah. And it just, and again, the challenge is always going to be, how occupied is the building?
Right.
What's the scenario? How
I
do we
have
get people?
one other thing to comment. Sorry, I'll let you chime in a second.
No.
So Jacob and I have a mutual client because they do, my team does a lot of leasing for them after Jacob sells the building. So then my team goes out and actually finds residential tenants. So our mutual client right now, they own a building that is like very run down. And tenants have been there for however many years, paying $500 a month. So now our contractors are also mutual contractors. They're renovating it. And now what I'm seeing, which was an interesting thing, is they were like, no, we don't want to make them like crazy beautiful, because if the contractor went in and made them crazy beautiful, yes, you'll get higher rents, which then pushes up the value of the building. But the renovation itself isn't going to push up the value of the building like it would in residential. So if you do all this crazy behind the scenes work and you put in $1 million in reno, you're only making that money back if that reno does get you that much higher in rent.
Yeah.
So doing the like minor renos to attract a good tenant based on it looking nice is what you want to do. But these crazy renos you'd see in residential to push the value up, doing that in commercial isn't going to push the value of the building up.
Spot on.
So interesting.
So and that's all about knowing your market,
Right.
So doing crazy renos in the right neighborhood of downtown Toronto very well could get you extra rent,
Yes.
right? Doing it in Hamilton, for example, where your max rent on a 1-bedroom is going to be $1,750, and that's like high end, right? And so that's in-suite laundry, dishwasher, kitchen, 2-bed, 1-bed, whatever, right? But yeah, you don't need to go super high end. The fine line is just enough reno to get you market rent.
Right.
And don't go over that budget.
Because then you think, okay, I have this beautiful building, but it's still only valued at what the income it's making.
Correct.
It's so interesting.
Yeah, it is interesting. Yeah.
That's cool.
Yeah, it's cool. Yeah.
Okay, so if we have somebody reach out to us, which very well could happen because I already have people talking about multi-residential, what would be, okay, I own a duplex, but I want to get into the commercial world. I don't know where to start. Would you start them with a 6 unit, something small, and just...
So it would all depend on their goals. And so when I do intakes, I just ask the W's: who, what, where, when, why, how, right? Honestly, it's that simple. Like, we just go through what it is, right? And we always start with, okay, what is the goal? What is the objective of you investing?
Okay, so I want to make
Brooke,
cash flow.
right? Yeah. So you want cash flow. Great.
Yeah, I have this amount for a down payment and I'm done with residential. I want
Why are you done with residential?
more cash flow and I want to refinance it at the end, take out all my money quicker.
Cool. Okay. So in that case, for somebody like that, I would say it depends on how much capital we have to put down, right? Because the thing is, running a 6 unit and running a 10 unit, they're going to run the same way, right? It's not like going from single family to triplex or duplex, right? It's a very small increment of difference. And it depends. Are we hiring a property manager? Right. Is Brooke cutting the grass that I'm going to see out there on Saturday, watering the driveway? Like,
so funny.
So
no.
Yeah. And so those are the things I like to ask, right? Yeah. And it's also, we get, for example, I'll get a client that comes in the door. Okay, I'm a doctor. I have 2 kids, 1 and 2 years old.
Yeah.
I don't have a husband in the picture, right? And it's like single mom thing. And then we're sitting there and she's like, I want to manage and operate my own building. And I'm like, no, we're not going to let you. Like, listen, if you really want to, go for it. But in those scenarios, we say, let's not look at a BRRRR strategy. Let's not look at the add value, right? Let's look at something a little bit more turnkey, meaning stabilized. Maybe it's already renoed, but there's good cash flow.
Yeah.
And we're going to go with a CMHC mortgage because they have a good net worth being a doctor.
Yeah.
So we can get you that cash flow without doing a ton of work. Now, someone who's really go-getter, right? Part-time job, maybe works at an office, doesn't, 9 to 5, has weekends free, then let's go look at that value add. That could be a 6 or a 10. I think things start to change when you get into 20, 30, 40 units because you have to run it more corporately, let's call it, right? You really need your ducks in a row. We'll get property management to that point.
Do you want to buy a building with me? I'm serious.
We can talk about this off there. I don't think our listeners want to hear about that. Once we do buy a building, yes, I'd like to do that.
Yeah.
We could go over the numbers on air.
Yeah. But yeah, it's once you get the math done up front.
I'm a math guy.
I know.
The banks, like I said before, the bank is smart. The bank's going to do your due diligence for you. Yeah. So what I like with commercial is if the bank gives you the mortgage, they've done the due diligence, right? I'm not saying don't do due diligence, but if you're getting the mortgage,
hilarious.
Like they've done it. The bank's not lending.
Yeah.
Because you get the mortgage, you're like, sick. It works.
Yeah. With res, it's like, okay, I got the appraisal. Great. I'll pay a little bit extra if I don't get the appraisal and still get the mortgage.
Yeah.
But with commercial, they're not looking at Brooke.
Yeah.
They're looking at the building. So they're putting their money down for the building itself. And so that's why they're making sure that business, that building is going to return them their money.
Interesting. Is there any buildings? So we work a lot in Halton, Hamilton. Well, you actually have a broader market than I would even say I do. But is there anything that you see right now as like, I want to have a client for that because I like it?
Yeah, there's a couple things, right?
Okay.
So there are, there's some stuff in London, Ontario that I'm quite attracted to at the moment.
What about Hamilton?
I like Hamilton. Challenge with Hamilton right now is Hamilton has a big tenants' right movement happening right now. And so I'm not saying that's a bad thing, but you have to be careful because there are people who are like, I want to go in, I want to do cash for keys, turn the building over, put new tenants in the building, and
refinance right away.
And I caution against it right now. I'm saying, hey, take it easy. We know enough people that are having, picketers outside their house right now because they're trying to turn units. So
Jacob's very good at slowing people down, which obviously you earn people's trust doing that. But I've heard Jacob say like, just wait. I know you want to buy now.
I was talking to somebody about this yesterday. I was like, I think I say no more than I say buy. Like I'm the worst realtor out there.
That's what I always say about myself too.
And that's how you earn people's trust because it's like you genuinely want your clients to do well rather than just sell them.
I was like, it's a busy street. You gotta, it's 11 a.m. now, but like imagine at 5 p.m. and they're like, we didn't even think about that.
Yeah.
And I'm like, I am the worst sales agent ever.
You know what? I'm sure that client's going to be with you
100%. In the
for
long
next
run,
10
you win.
years,
Yeah,
right?
in the long
Or
run, you win.
20 years, whatever.
Yeah.
Well, you're looking out for their best interest. So I've heard Jacob say, "No, we will wait.
Yeah.
Just
Yeah.
chill."
Yeah.
Okay, let's pivot here. I got some economic
hit me.
questions.
Yeah.
Okay, so Canada just saw 424,000 Canadian citizens leave. And what Canada's doing is they're masking a problem. You have Canadians leaving and you're immigrating people.
Yeah.
So you work with people who are investors, and investors go where the best money is for the most part. What do you see in the market with your investor clients? Like, are they still bullish on Canada?
Yep.
Are they going elsewhere? And I guess, are you bullish on Canada?
That's a great line of questioning. I like that.
Yeah.
Okay.
Even the way you delivered it.
Yeah, no, that's fantastic.
CTV happy on the news.
Let's work that and unpack it. Yeah.
Yeah.
So first off, I agree with you. So there is a lot of investors, and I'm not going to talk about, people leaving Canada residency wise, but I'll just talk investors wise.
Yes.
So even a lot of my clients have come to me and say, Jake, do you have anybody in the US that I can talk to? Because we're looking at investing in the States or in Europe or in the islands. Because Canada's not working right now. The rent control is not great. There's
The people in
just
power aren't great.
the government's not working for us, whatever it may be, right? So I agree with you fully on that. What we're seeing in the market right now is there still is a big demand for multifamily with investors. However, they're being very selective on what they buy. And what's interesting with the market right now is it's giving opportunity to investors to start having creative deal structure, right? So over the last few years, the market's been so crazy, as I'm sure everybody knows, there was no deal structures anymore. It was just like, how much can you pay?
Yeah.
Right.
Oh yeah.
Give me my check and I'll sell you the building. And I think that in combination with all the other reasons people were leaving the country aggressively to go invest elsewhere. I started to see people come back investment wise into Canada because of that creative deal structure now, right?
Okay.
Long term, I believe in Canada. I believe in Ontario. I think it's a great appreciating market. And in the next 10 years, we're going to be in an even better spot. And that might be because of great leadership, or it might be because
An even better spot for who?
investing.
For
Investing.
the people investing, or if you buy now, having been invested.
Both.
Okay.
Both. Because I truly believe like we have a housing problem and it's not getting better, right?
No.
And this is why people are leaving, but it's also why investments here are going to start making even more sense. Like my crystal ball, you ask me, I think within 3 years, housing prices are going to skyrocket and it's going to be almost unattainable, right? If we want to go down that road, but there's a unique opportunity here. Now, what I've been telling my investors to do is diversify your portfolio. I always believe in diversifying, right? I have no issue with my investors going to
You
the
have
US.
the most diverse portfolio.
I like a diverse portfolio, right? So I'm telling my guys, go to the States, go buy something in the US, go buy something in the islands. But when you analyze stuff in the US and when you analyze stuff elsewhere, you do your numbers a little bit differently. There's not much put on appreciation.
Well, there's so many more people. There's so much more infrastructure. So like Canada being huge with this much
Right.
density.
Density,
So,
yeah.
so where am I? What do I believe right now in the market is, I do think people need to diversify, right? If you have the money and you have the vision to do so, I would say go look at buying some stuff in the States, but let's keep a few or buy a few in Ontario right now as well. And I think that's the path forward right now. But yeah, deal making in Ontario right now is fun. Like there's some pretty cool stuff happening.
So on that topic, deal making, other than you being a very successful commercial broker, you also have your hand in a couple other things.
Yep.
One being private lending. I know you own a campground or something crazy.
Yeah.
You do Airbnb at your cottage. Like
Jacob lives in a tent actually.
Jacob actually we'll be in the office and he'll like tell me about something and it'll be like one day it'll be like I'm going to the campground and I run a campground and I'm Airbnb this cottage and I want to sell my house in Burlington. Oh, I just bought a building in Burlington. And
Yeah.
Okay, so tell us about your private lending sector that you have going on, because
Yeah.
I know a lot of clients actually go to you for that reason.
Yeah. And I just before we jump into that, I do want to make sure, Cortez, did I answer the question for you?
Yeah.
We got-
I
okay.
think you're bullish on Canada because of our population growth, but also you think that leadership's going to change and better things are coming.
Yeah.
If we stayed under the current leadership, I guess, would you be bullish on Canada?
Ooh.
That's a good one.
I'd be more cautious,
Yeah.
right? But listen, I had
Sign
this
the petition?
conversation with somebody the other day. Sorry, Brooke, I know we're going to jump into your question in 2 minutes. But I had a client of mine come into the office who's like, I'm done with Canada. Don't send me anything. I'm full into the States. Like, I don't even want to talk about Canada.
Yeah.
And
understandable.
understandable. And
That economy
he was
growing.
explaining his reasons and why and this and that. And at the end of the day, I'm still Canadian. I'm born and raised in Burlington.
Good Canadian boy. That's what I like to say.
I believe in the market here. I do think things will turn around. And I do think it's supply and demand. We don't have the housing. More people are going to need a rent. Things are going to become more expensive. And being a multifam building owner for let's call it middle-class person, right? Like a middle-class profile, I should say, of renters is the best investment I think you can do right now.
Cool.
Right? Because that's going to become a big sector of renters.
Yeah, no,
right?
it's good.
If they can't buy. So, okay, now on to Brooke's question.
Yes.
What was the question?
So I've learned a lot from just listening to you next door.
Yeah.
So not only do you have conversations with clients that are buying commercial properties, but you have this private lending sector of your business where if somebody has, $100,000, they're like, I don't know what to do with it.
Yep.
And there's nothing really that you can suggest in terms of buying a commercial property. Sometimes we turn it into a smaller res. We'll take care of that together. Or you switch them to private lending. So giving that $100K to you invest it for them.
No, so they don't give the money to me.
Okay.
Okay, so I'm not licensed. I'm not licensed to do any of that. So no.
Jacob is running a Ponzi scheme. No.
Yeah, no money comes into my pocket whatsoever. Again, I'm going to just bring this back to a more holistic investing approach, and that's what I like to, the culture of my team and the culture of what I do is what I believe in. It's holistic investing, right? Which it doesn't have to be just real estate, right? Again, I'm a terrible realtor. I tell my clients not even to buy real estate. But it's all about the diversification of your portfolio. I never like all the eggs in one basket. So we can look at the passive or private lending side. I also look at stuff like REITs, right? Which is a real estate investment trust. So this is a investment vehicle where the REIT will own assets, will own apartment buildings, gas stations, whatever it may be. And the public can invest in that company and own shares or units of that company, which are going to pay.
How do you get it to be a publicly traded stock right away?
Yeah. So it's not publicly traded at first.
Yeah.
Usually what happens, it's a private REIT.
Yeah.
Right. So there are public REITs. For example, the biggest one would be Starlight.
Okay,
REIT,
so how do
right?
you get it from private to public? Because I'm sure it's way better once it's public.
Yeah, so that has to do with the company itself, with the REIT itself, and if they want to go public with their stocks and shares, right? So when they're ready to go public, they're going to.
And it's just a matter of you deciding.
It's on the company, right? So what I like to do is, okay, so if you want to get into a private REIT that might be going public, well, I'm sure you're going to get a boost in your shares once it does go public. So that's something to look into.
Yeah,
right?
you want to get on the private floor first.
Yeah, right. So
all these guys get rich.
Yeah, and so with coming into a private REIT, there's a lot of benefits. Usually the returns are higher because it is private. They can do that. It's not as spread out.
Who's the one deciding what to buy with everybody's money?
So it would be the trustees of the REIT, and then they would have direction from the board of directors. So every REIT's going to have a board. The board has to vote yes or no, which is made up of.
And just like a stock, there's risk that if that asset that you purchased doesn't work out, you could.
Yeah.
Yeah.
And so, but for something like you look at, again, Ontario, Canada, GTA, it's pretty safe to invest in a REIT that's buying in the Toronto area, the GTA area for multifamily. And each of these REITs have different return structures, right? So some are going to give you monthly passive income with growth of your units, right? So you can get
so then after a certain amount of years, you have equity.
Just like stocks, right? You can sell it, take it away,
you have a dividend
do your own
and
thing.
value in your actual portfolio.
Exactly. So these are things that I can talk to clients about as well, to say, hey, you know, maybe we buy one building, but then we use a little bit to go do something else. Great example. I had a client come to me earlier last year. Hey, you know, he said, hey, Jake, I just sold my building. I'm sitting on $3 million. What do I do with it? Right?
Did he sell it with you?
Actually, he came to me after. This was a brand new client.
Oh, was it?
He called me off of realtor.ca on one of my listings. Yeah. And we ended up building a really good relationship quickly. Sick. And you know,
because you're so smart.
Yeah, no, we had a couple good lunches and we talked about investing and what he wants to do. And what he said to me, which was really nice to hear, he's like, Jake, like nobody's sat down with me and asked why I'm investing. What do I want to do? They just always say, well, here's a building, $3 million. Yeah, here's a building, right?
Yeah.
Here's a building that's going to take $3 million to buy.
I'm going to make 60 grand. Oh yeah.
And that's it. So I took my approach, which was, you know, slow down to speed up. We met. What do you want to do? Why do you want to do it? What are you looking for? So his goal was, I want $10,000 a month in my account every month. How does that happen? I don't care. Just find me a way to make that happen. Okay, great. Right. Plus I want to be able to give my children something when I, you know, either pass on or whatever it is. And so with that guy in particular, I said, listen, I go, why don't we spend $1.5 million on a building? Right. So we ended up getting him a really nice building. I think it was like 50 units or something.
50.
So it was a good building. We got a great CMHC mortgage. It was 95% loan to value.
Sick.
So he put his $1.5 million. I think maybe it was $2 million at the end of the day. But I told him, I said, let's do $1.5 million in a building. Let's do $1 million into a REIT, so it's a bit more secure. Yeah. Right. And whatever's left over after you buy that building, we're going to put into like high interest passive lending approaches. And we went through the broker channels and everything to do all of that. But yeah, so now he's got his 10,000 a month plus and his 50 unit building. And in 2 years, we're going to hop back on a phone call, or I talk to him regularly, but we're going to refinance and or sell that building in the near future, pull another 3, 4, 5 million out of it and do it all over again.
Yeah.
And so we're going to build him some generational wealth with short-term money as well.
Very good.
Very
Very good.
Wow, that's so interesting. Yeah, I like the idea of REITs. That is on my 2024 goals of what I want to do this year. I wrote down, it was very, very intricate and specific because your goals have to be specific. And I even mentioned your name.
Okay.
Learn more about REITs.
Feel
and like,
special.
Literally on my 2024 vision board, your name is mentioned when I talk about REITs. And that's like something that I want to obviously go towards because like, I love real estate. I love what I do, but it gets like redundant and stuff. And it's like, I can only talk about duplexes so many times. Like I want the diversification of being able to help people in other creative ways that maybe some realtors wouldn't know of. And a lot of people wouldn't know how to speak like you do.
It's another tool in your belt.
100%.
Right. If a client everything's negative cash flow in the market, well, why don't we buy something negative cash flow with half of your money and invest the other half, and there's your cash flow.
That's the most interesting thing is that when some people use HELOCs to buy, let's say they want to do residential, they buy a duplex, it's $500 negative per month, but you got a great purchase price. So I don't even really worry about the $500 negative, but if you're worried about that, then you use $100K more of your HELOC money because usually your HELOC money could pay for your down payment and you'll have a little bit left over. Use that with private lending, so you're using a little bit more of your HELOC, but that private lending is going to cover that use of the $100K plus a chunk of that negative $500. Now you're utilizing
calculator.
Yeah. Now you're we've done it in our pro formas. We have this section in our pro formas that we could obviously run, but sometimes utilizing more of your HELOC, so taking more debt out, but then using it in two different spots can mitigate some of the negative cash flow. But at least now you've gotten a great purchase price on
good debt versus bad debt, right?
Yeah.
And looking at your investment as a portfolio rather than just one or two individual buildings, right? A little bit of positive here offsets a little bit of negative there.
Yeah.
Overall, what is my return on my 5 duplexes or my 2 buildings or whatever it may be? That's the top-down kind of education.
How do you calculate your net worth?
How do you calculate net worth?
Like if somebody has like 4 houses or something, and then this mortgage on each, and then obviously a business income, like
Yep.
versus salary.
So, well, we have
Let's call it a commission income. Like, let's do.
sure. Yeah. So our team, we've built a net worth like calculator.
Yeah. Oh,
It's an Excel spreadsheet. It's not that cool. It's really, there's nothing sexy about it. It's very, very boring. But it's just to help us. Cause again, that's something that we're going to talk to our clients about. Like, I'm not a broker. I'm not a mortgage broker. I asked for net worth because I want to understand my client on a deeper level and understand, let's go back to the holistic thing, right? I want to holistically understand where the best investment is for this client. So we do get all of our new clients to fill out a net worth statement. That is going to go to the mortgage broker when that time comes, but it's something good to do. So, I go top down, I look at it, I say, okay, first things first, cash in the bank, right? What do we have cash in the bank account? And that can be your corporations and your personal. Then I'm going to go to like gold, silver, investments, things like that.
aside from real estate,
No, we're not on real estate yet. This is just
like stock investment.
Stock investments, like actual gold. Like, do you have a gold bar in your closet? Right? Like,
What about watches and purses?
yeah. Right.
Oh yeah, we were talking
I
about
love
your
this stuff.
art. Your art.
I was going to jump to that.
Want
Yeah.
to have like such nice piece of art because it actually attributes to your net worth.
My goal is to have like 500K in
hilarious.
art, right?
Yeah, it's what
That's so funny.
which is crazy. And I was watching something the other day. What was it? It was like a YouTube thing on like a multi-million dollar home in Florida or something. And the realtor that was walking through it was like, yeah, that, I know the house is $100 million or something. She was like, but the person that's going to be buying this home, like the art they're hanging on the wall is going to be 50 million. So what is $100 million house when you have art where, and I thought of that. I went, ooh, that's cool.
That's so funny.
That's where, anyways, but yeah. So holdings, yep. Anything valuable, holdings, vehicles, right? So what is your vehicle worth? How much debt do you have on the vehicle, right? So it's all income versus debt, just like we'd look at a building, right? What are the utilities? What are the income of the building? And so we're doing the same thing for your personal net worth. We go all the way down to then real estate, right? What is the equity of that real estate? We're only going to look at equity. And then are you in a partnership, right? So is it 50-50? So is it 50% of the equity yours or is it 100%? And then credit card debt, lines of credit, things like that, right?
So then you would add up equity on every real estate plus assets like gold and art and stuff, plus money in the bank.
Yep, pretty much.
So that's your net worth.
That's more or less, yeah. And I'm sure I'm missing 50 different things right now, but just right now, yeah, that's more or less. It's going to be your assets and your liabilities.
But what about your income? Don't you add that as well?
Well, so income's going to be looked at a little bit differently. Income for the mortgage broker, yes, they're going to look at that as part of it. For our purpose, I just want to know what you're holding currently.
Okay.
Right. And so for CMHC, it's going to be your income and all of your assets as well versus liabilities.
So your income per year added to your stuff.
Yeah.
So 1 year of income plus your stuff equals.
Well, unless you're self-employed, like us, all of us, right? And then you're going to look at a 2-year average.
Okay, of net.
Or
obviously.
Very good.
So, yeah, and so that's something we go through and look at, and again, when the time's right, the mortgage broker is going to need that to review all of that, anyways. So investments, and then like mortgage investments and things like that. It depends who you talk to. I put them down because, like, really, if I did need to like get that money out, I can within a reasonable time period. What do you usually do, Cortez? I know
the terms that I go.
Like when you're doing a net worth statement,
okay.
Do you consider your private lending, your passive lending as how do you track that in your net
Definitely
worth?
does. Cortez loves his passive income.
Yeah, no, I do.
Well, we were talking for
goals.
an hour before we started the show, and we honestly, instead of talking about a topic for the show, we just ended up talking about lending and stuff. But
yeah, no, for sure. I think that is income in my opinion, right? Like I don't own the houses that I private lend on.
Are you attached to the title?
Yeah, but it's only if they default. So if they default, then
are you in second position?
Depends on the deal.
Yeah.
But if they default, then me and the other investors
Could you force a sale?
Yeah.
Because if you're in second position, you could.
Of course, I could force a sale. That's
or buy out the
that
first.
I wouldn't do it if there was no hard asset behind it. Then I would never do this. But because the last thing that people are going to default on is their home, they're going to get rid of everything else. They're going to call mom and dad for a loan. They're going to call whoever for a loan because you need a roof over your head for the most part. That's why I think private lending is a good investment for myself. And the fact that I have just right now in my life, it covers everything, all my expenses. It won't forever because I think maybe one day I'll have a family or something like that. Things are going to drastically change if that does happen. And then I just have other goals and stuff that I want to get to. So yeah, I look at it as an income for sure right now. Yeah. If that makes sense. But do I think of it as like a net worth thing? Yeah, that's that. I don't know. I gotta think about that. Yeah, because there's no real hard asset behind it that I personally can just like go out and sell. Yeah, but if I needed to liquidate everything, then yeah, I'd have the cash and could put it somewhere else.
Right on.
I'm having ADHD now.
Oh, you want to wrap this up?
Yep.
All right. Anyways,
I think that we should have Jacob on more. I feel like people want to listen to it.
Yeah.
Don't you have a podcast that people could listen to?
I do. So
yeah, where can people find you? Yeah.
Yeah. So I wouldn't even call it a podcast. It's kind of short form content. It's called REI Hot Seat, which is Real Estate Investor Hot Seat. So what we do is I do it with my brother-in-law, Andrew Hines, who runs his own podcast, Andrew Hines Real Estate Investing Podcast. And so we sit down and we find a property. We bring in a property. I'll review it quickly. Andrew will review it quickly. And then we sit down and we basically bring up a spread chart. So it's very analytical.
Yeah.
Like you got to be a numbers person to enjoy it. Right? It's niche. But we sit there and we do 15, 20 minutes, 25 minutes at the most of deal review. So let's look at the deal high level, right? Location, asset itself, condition. And then we say, who is this for? And then we look at, is this a good investment, right? And how would we buy it? Or how should somebody buy it? Whether that's like a vendor take back mortgage, maybe CMHC, maybe private bridge.
And is it all commercial?
This show's all commercial. Yeah. So we've done development sites. We recently did like a storage facility. We do apartment buildings, gas stations.
Cool. So cool. So
yeah.
REI Hot Seat is where to listen to that.
Yeah. And that's on YouTube and all the podcast channels.
Very cool.
And if someone wants to use you as a commercial realtor, how can they find you?
Yeah. So, I'll give you guys a link.
We'll put a link below.
So you guys will have a link below.
His last name isn't as easy as to spell as Hicks.
And yeah, so if anybody wants to go to the link, they want to get in contact, go to the link, sign up. I will have one of my team members reach out.
Yeah.
From there, they'll basically ask the W's, the who, what, where, when, why. At that point, I personally get on a call with anybody who comes in.
Yeah.
And we're going to go through the whole plan.
My office is also literally next door to Jacob's, so feel free to DM the podcast, and if it has anything to do with commercial, anything to do with commercial, it goes to Jacob anyways.
Yep. And we can go through it together. Yeah.
Excellent.
Exciting.
All right, cool.
Very good. I think that was so educational for me too.
Never mind.
I'm gonna put this up as like, this is a learning episode. Like, listen to this one.
You might have to pause it and look up some terms, but it's good.
I know we ran over some stuff quick.
No, that was really
good. We'll do another one where we can talk terminology and slow it down a little bit.
Love that.
Appreciate it. Yeah. All right. Anyways, guys, thanks so much for tuning into this episode. Please like and subscribe if you're on YouTube. If you're on Spotify or Apple Podcasts, leave us a review. That's one of our goals this year, is to get some more reviews there. Short form, you know where to find us. And if you want to book a call for residential stuff, there's a link down below for our calendar for us and Brooke. It's totally free. It's half an hour. We'll go over any of your real estate goals coming up for 2024. And we've been working with some people in the podcast. It's been going great so far. So we definitely want to keep that train rolling and help you guys kind of achieve your goals. If you're not in our area too, we can recommend an agent who is like-minded to us in your area too. So yeah, book that call down below and we look forward to speaking with you.
Thanks, guys.
See you next week.
Thank you.
Thanks for coming on, Jacob.
Excellent. See you.
All right, take care.